Thanks, Rohan. We, just so everybody knows, we're each going to take 15 minutes to talk about our papers, and then Corey will speak for 15 minutes. I'll be the residual at the end, and then we'll save 15 minutes for questions from the audience. So as you have them, you want to note them down and save them for later. Our next presenter is Shohini Kundu from UCLA.
Okay, so thank you for the introduction. The title of this paper is Canary in the Coal Mine, Bank Liquidity Shortages and Local Economic Activity. This is joint work with Raj and Nikos. So the aggregate US economy is essentially a collection of different regional economies operating within it. However, as highlighted during the Great Recession, there can be substantial variation in regional economic activity, as we can see in this plot. So during the Great Recession, 35 out of 51 states and a federal district experienced a drop in GDP growth exceeding 2%. Other regions, interestingly, experienced less severe declines, and some regions even experienced positive economic growth during the Great Recession. This heterogeneity in economic growth underscores the spatial differences in the accumulation of risks. So understanding the vulnerabilities of regional economies to economic contractions is important for developing targeted fiscal policies and effectively implementing monetary policy. Empirically, the challenge has been measuring the susceptibility of different regions to economic shocks. So in this paper, we introduce a regional vulnerability index that assesses the spatial buildup of regional economic and financial risks. This measure uses spatial variation in banks' liquidity shortages. So in this figure, we're presenting the deposit rates for single state banks. This is the same bank in the same year, looking at how different banks set different rates in different regions. So you can see in the darker shading, the same bank will set higher rates in certain regions and lower rates in other regions. And so the name of the game is to understand how these deposit rates might be portenders of future economic activity in those areas. So let me be specific of the channel we have in mind. First, as a regional economy begins to approach an economic downturn, individuals don't make as much in income and firms don't generate as much in profits. So as a result, aggregate deposit growth of that region begins to decline. Now, when aggregate deposit growth declines, this puts a strain on bank liquidity because deposits constitute a substantial source of bank liquidity. And in response, banks can either take one of two actions. They can either raise rates to attract new funding, or they can reduce lending activity. So the key idea is that if a bank originates $100 in loans, they expect to get $100 in deposits in the future to support the lending activity. But if they end up with 90, they now have a hole that they have to plug either by raising rates to attract new deposits or cutting lending activity to $90. So based on the premise that there is a relation between local bank liquidity and local regional activity, we introduce a regional vulnerability index, which is the average deposit rate offered on insured deposits within a region. Now we show that this granular indicator of economic activity can predict economic activity at the county and state levels, complementing existing measures that are used to predict national economic activity, which often make use of Treasury yield curve data and survey-based indices. We show that this indicator can predict economic activity at longer time horizons than the existing leading measures and with a high degree of accuracy. But importantly, we show that this measure can predict even in periods where there aren't changes in monetary policy. It's not associated with large expansions in credit, nor are there imminent national recessions. So what do banks do? When banks approach an economic downturn, we see that there's a change in their composition of funding. And banks rely more on insured deposits, moving away from uninsured deposits. The substitution from uninsured deposits to insured deposits raises concerns of moral hazard because essentially the risk of the bank is transferred to the government when the bank is approaching bad times. So let me jump right into our findings. In this figure, we're presenting the relation between deposit rates at the county and state level and GDP growth 2 years later during the Great Recession. What we find is that if you were a county or a state with a higher deposit rate in 2006, you were expected to experience a worse economic decline 2 years later during the Great Recession. And we can also look at this figure differently, which is to look at whether the deposit rate can predict large drops in GDP. We take counties and states and we categorize them in 5 bins. We find that if the county or state offered a deposit rate belonging to the 5th quintile, they had a 35% chance of entering a recession in 2008 compared to a 10% chance if they offered a rate in the first rate quintile. So these patterns motivate our inquiry into whether these relationships hold for a larger sample and over a longer time horizon. We begin our analysis at the county level, and then we work our way up to show that there's predictive value at the state level as well, and if we aggregate to national. We begin by focusing on metropolitan counties. We do this for 2 reasons. The first is that metropolitan counties exhibit a competitive banking structure, and the second is that these counties comprise 60% of national GDP, and that doesn't change over time. So what we show is that the county deposit rates provide a useful vulnerability index for assessing economic activity measured in a multitude of ways. The first thing that we do is we regress GDP growth at T+1, T+2, and T+3 on deposit rates today. And what we find is a remarkable relationship between the deposit rate today and future economic activity. Now, for the economists in the room, you may be concerned that this might be driven by time-varying factors. And while there may be a global time component that drives county-level recessions, A, it's not useful from a forecasting perspective, and B, because it's not known ex ante, it doesn't have that much value for the purpose of prediction. Now, we do include time-fixed effects for the purpose of making sure that this relationship is robust, and indeed we're picking up on some local factors. So after including these time-fixed effects, we find that a 1 standard deviation increase in deposit rates is associated with a decline in county GDP growth by 0.44 to 0.73 percentage points 2 years ahead. Now, this is substantial considering that the average county GDP growth is 1.25 percentage points over our sample period. Now, while GDP measures the value of goods and services that are produced in a region, there may be concerns that it's influenced by external factors such as trade. So instead of using GDP growth as our outcome variable, we look at a direct measure of job creation and destruction, which is change in employment growth. And we find remarkably similar results that higher deposit rates today predict lower employment growth in a region 2 and 3 years down the line. Another measure of economic activity that we use is new business formation. And the way we measure new business formation is the number of applications for a new employer identification number with the US Census. Similarly, higher deposit rates today predict lower new business formation in the future. So what about households? Moving away from measures of business activity, we look at a measure of consumer financial health, which is the 30 to 89-day mortgage delinquency rate. The 30 to 89-day mortgage delinquency rate provides a measure of the overall health of the mortgage market, capturing borrowers that have missed 1 to 2 interest payments. So a higher delinquency rate can be reflective of greater household financial stress and reduced spending capacity. And indeed, what we find is that areas which have a higher average deposit rate today are predicted to have face a higher early stage delinquency rate in the future by 0.3 to 0.4 percentage points. So that suggests that the potential for credit losses is higher. And in terms of the magnitude, this is quite substantial given that the average effect is average delinquency is 2.5 percentage points. Now, while we show that the deposit rate can predict economic activity at the regional level, we also show that it can predict sectoral activity. So if we identify the most dominant industry in each county, we find that the deposit rate can predict employment growth within that industry, the wage growth in that industry, as well as business activity. In addition, we show that our findings are robust to different measures of deposit rates and a number of additional outcome variables. One might be concerned that perhaps the predictive value that we have is limited to specific time periods of our sample. So we show that we can predict at a fixed point in time in 2006 in periods where there aren't changes in monetary policy. Deposit rates can predict recessions even after accounting for changes in credit growth and across bank size distribution. So, in addition to assess the predictive value, we use an efficient rank-based algorithm known as the area under the receiver operating characteristic curve. Won't go into the details. The key takeaway is that we find this AUC value is 0.73, which is as high as many cancer diagnoses in the medical sciences literature. So the key hypothesis that we have is that deposit rates reflect the liquidity shortages experienced by banks. To validate this, we look at a natural experiment, focusing on deposit rates around natural disasters. So natural disasters are unforeseen, unanticipated events that signal the onset of an economic downturn. Unlike other economic downturns, the timing of recessions induced by natural disasters is more certain. And in addition, they are orthogonal to monetary policy movements, large expansions in credit, and precautionary savings motives, so it provides a useful setting to identify the relation between liquidity shortages and deposit rates. Now, our hypothesis is that deposit rates should only increase after a natural disaster occurs, signaling the onset of a downturn. Consistent with this, we find that rates increase for 2 years following natural disasters, after which they begin to decline. So to understand whether the increase in rates actually reflects liquidity shortages, we turn to microdata, identifying the deposit growth of each bank in each county around natural disasters. And what we observe is that in the year following natural disasters, there's a decline in deposit growth of 5 percentage points. This suggests that as banks approach a contractionary period, they experience a decline in deposit growth, which strains bank liquidity and prompts them to raise rates. Now, given that these natural disasters are unforeseen events and liquidity drops after the natural disaster occurs, we don't expect the rate before the disaster occurred to be predictive of economic activity. And indeed, we find this ex-ante deposit rate can't predict these unanticipated recessions. However, the ex-post rate can predict future GDP growth. So following a natural disaster, if the average deposit rate in a county increases by a lot, that's suggestive that there's going to be a worse economic decline 2 years down the line relative to a county that raises its deposit rates by very little. So the paper delves into the underlying mechanisms. Let me just give you a quick summary. What we find is that when a county approaches an economic downturn, total deposit growth goes down at the county level. Now, what we find is that at the bank level, insured deposit growth declines across the board, but uninsured deposits decline more for banks that are riskier. And as a result, to offset the shortfall, banks raise rates to attract new insured deposits. We show that the extent to which they raise rates depends on the magnitude depends on the degree of competition as well as the strength of balance sheet conditions. Lastly, we show that the deposit rates also have predictive value for predicting economic activity at the state level. We assess the out-of-sample predictive value through k-fold cross-validation. We show that the predictive model generalizes well to independent data sets, and this is useful for flagging issues such as sample selection and overfitting. And overall, the findings are consistent with our hypothesis that this vulnerability index can predict recessions years in advance. Now, an additional test we can do at the state level, which we can't do at the county level, is look at whether the deposit rates can also predict the risk of failures of financial institutions. So here we have the rates on the x-axis, and the y-axis on the figure to the left indicates the percent of states that experienced any bank failures, and the y-axis on the figure to the right indicates the percent of bank failures within a state. What we find is that a 1 standard deviation increase in the deposit rates in 2006 at the state level increased the likelihood that that state would experience any bank failure by about 19 percentage points. And a 1 standard deviation increase in the state deposit rates in 2006 was associated with a 0.66 percentage points increase in the share of failed banks within that state. Now, lastly, you might be wondering, why are deposit rates special? Couldn't we look at other bank variables to predict economic activity or even other non-financial indicators? So to study how the predictive value of deposit rates compares to other indicators, we run a horse race between the deposit rates with other bank variables, including measures of deposit growth and credit growth, incorporating small business lending, mortgage lending measures, as well as the sum of the two. And we find that deposit rates can outperform these bank-based measures. In addition, we run a horse race between deposit rates and non-financial variables, such as auto sales, the number of auto sales, number of unemployment insurance claims, and the number of job openings, and similarly find that the deposit rate outperforms. The reason may be that deposit rates are a forward-looking variable that it aggregates information a bank may have on underlying economic conditions, whereas many of these variables tend to be backwards-looking. So to conclude, this paper does 3 things. First, we show that bank liquidity conditions can predict business cycle fluctuations. We can predict at the county and state levels. The key mechanism is liquidity squeezes. When economic growth slows down, deposit growth slows down, prompting many banks to raise rates. Lastly, this is a useful policy tool to equip regional authorities with an additional tool for obtaining an early warning signal on the conditions of the economy and implementing optimal stabilization policies. It's a market-based measure that's easy to construct, and it can be useful. Thank you.